Hello, everyone, and welcome to At Barron's. I'm Andy Serwer, and welcome to our guest, David Gross, Managing Partner of Bain Capital, which is a large global private investment firm. David, nice to see you.
Good to see you. Great to be here, Andy.
So tell us about how you measure the scale of Bain and how you would measure success at the company.
So it's a great first question. We are perhaps a little bit different than our brethren in the industry in that we don't look at really assets under management as the primary mark, but really it's our investment returns and our investment performance. Our overarching goal as a firm is to generate superior performance for our investors. We're really looking for that premium level of returns driven by alpha that's built on real capabilities. And so it really is the economic profit that we're able to generate for our investors that's the key KPI that we're focused on.
And what sort of numbers can you share with us that would speak to that?
Well, we want to be in certainly the first and second quartile of returns, and we're really shooting for very significant 1,000 basis point premiums to the relevant indices that we'd be looking at. So we're shooting for high performance that's going to compound over a long period of time. That's going to be differentiated in the way that we generate that performance. Largely driven by value creation. We have to think about the buy and the sell, but it's what we do in between that really matters in terms of driving operating performances and changing trajectories of our businesses. And that's the surest way to generate that performance through cycles, through market environments. There's going to be ups and downs. But if you can add value to the businesses throughout, that's the surest way to achieve that goal.
Can you speak a little bit more to that point about differentiation? Because, frankly, a lot of firms say, we're looking to do this and that, and I'm wondering exactly how Bain is kind of different.
Sure. Well, we're different number one in that our heritage is deeply rooted in this consulting-oriented, highly analytical approach. And so we have very, very big teams of folks with those consulting and operational backgrounds, obviously complemented by folks in the financial industry. But we really have the largest team per any metric, asset under management, in terms of folks that can go in there and analyze businesses and improve those businesses. That's number one. Number two is we have a very deep dedicated value creation effort of some 200 people that all they do is they're in there driving value companies, developing and supporting strategies of our businesses. And that's all, we're supporting that. That's a big investment that we're making as part of Bain Capital. Third, I would say, is really the deep vertical expertise that we have. We're organized, vertically, and we're trying to bring tremendous level of detailed expertise. I mean, the reality is that the world is organized that way, and healthcare companies want to deal with experts in healthcare, and industrial companies want to deal with people who know how to run factories and understand the factories of the future. And we're able to do this because we've got a number of different asset classes, but we get them working together on these industry thematics and verticals in such a way that it really expands the depth of team we have. So if you take any given vertical opportunity, we probably have 50 to 60 experts in the firm globally that we can throw into a situation. So this kind of scale of team and the depth of team, I think, are probably the ones I'd point out as being most unique.
And you spoke about that consulting legacy, which speaks to the origins of the firm.
Yes.
So what are those origins, and where did the company come from?
Well, we were founded in 1984 as a spin-off from Bain & Company, the consulting firm. And the idea back then is that Bain & Company was developing great insights that would have tremendous impact. Right. But was there a way to then drive that into execution and to participate in the upside that was created from those insights? And that was the whole thesis behind the firm.
And the companies are separate. Mitt Romney was instrumental in setting the company up, but then they're totally separate at this point.
They are separate. We'll work with the Bain & Companies and the McKinseys and others and BCGs of the world, but they are separate firms. But the ethos of the firm of the firms are very similar. We're highly analytical. We're collaborative, where we're interested in building content and knowledge that can help support an initial investment, but then pay dividends for future investments as well. We take very seriously knowledge management and creating centers of excellence in certain capabilities, whether it's go-to-market or procurement or technology and AI to take some of the newer ones. And so there's some similarities, but we're an investment firm that raises capital from third parties and generates a return on that capital.
Now, David, there's a lot of talk about private equity and the cycle and sort of more difficult times, comeuppance, if you will, particularly in certain sectors. I'll get to that in a minute. But what is your take just generally on the macro view for private equity?
Sure. Well, through all these cycles, and you're describing a current cycle that we're in, and we've seen cycles like this before. The industry will invest and there'll be an upswing in investment velocity, and then a period during which you'll digest all those investments. And that's kind of what what you see in this current cycle. There was a very peak period in the 2021-22 period. And so some of the, as you mentioned, comeuppance question is around the point we are in that cycle. But generally speaking, through the cycles you've seen steady growth. This is an industry that's growing in double digits in terms of its available investment opportunity. It's still pretty low in terms of penetration of the available opportunity. It is globalizing, and so we've been big in supporting the global expansion of our business. More than 50% of our business is outside the United States. So that's another growth leg. And then there are all these interesting vertical thematic trends that our industry is investing behind, like healthcare, like technology, like aerospace and defense, fintech, and the like. So I still, from a macro perspective, have a very constructive view on the growth prospects for the industry. But we always have to ask ourselves the question: what point are we in the cycle? What are the industry challenges and opportunities at that point? And then step back and look at what the long-term curve looks like.
In private markets, one area that's been of particular concern is private credit. You're in the private credit business a bit, and the specific part of that people are concerned about is software. So my question to you is, how much exposure does Bain have to software in your portfolio?
Sure. So, first on private credit, yes, we're a participant. We participate in a specific segment, which is the middle market. So we're not providers in the large cap segment, and we've chosen that because there are better lender protections in that segment. You can have a bigger role in the kind of debt consortium that gets formed, and we've been in that business since the late 90s. So it's a very long-term business. On the large side, we don't provide debt, but we are users of a large cap private credit to fund our buyout. So we're present in really kind of both sides of this market. As it relates to technology, technology has been a big part of the broader industry's private equity mix in this current cycle, upwards of 40-50% at the industry level. For us, we have a very diversified portfolio across sectors. I mentioned healthcare and industrial. These are equal-sized sectors for us alongside technology. So technology overall is maybe a quarter to 30% of what we do. Software is maybe probably less than half of that, so something in the 10 to 15% range. But listen, I think with all the concerns about private credit and software, there's been a bit of a conflation of what the real issue is. First of all, not all software businesses are created equally. There are very different ones. Most of them are highly cash flow generative, stable, have good technology positions. And so you really got to do the exercise of going through where they're positioned relative to some technology trends. And not all ones that were funded with private credit are over leveraged. So I think there's a little bit of a baby out of the bathwater phenomenon going on with this right now. But that's how we see the relevance of it to our portfolio.
So nothing concerns you specifically. It's not a big concern of yours.
I don't think this is a bubble. I think there has been a bit of a search for the next bubble in this last economic cycle because the economy has been so robust for so long. It surprised many of us that folks are kind of looking for what's the thing that's going to upset the apple cart. I don't think it's private credit, and actually I don't think it's software either.
The Department of Labor recently proposed making it easier for private investments to go into 401ks. What's your take on that specifically, and more generally, retail investors going into privates?
Specifically, it's good that there are more rules being outlined to ensure that there's transparency and disclosure, and that this is all being done in a way that's good for the investor. The broader trend here, though, is about access to an asset class, alts, that hasn't been broadly accessible, particularly to smaller investors. It's mostly been institutions and very high net worth players. And I think if you look at the asset allocation that is a good one for a pool of capital, it should have a significant portion, 15 to 20% of alts in it. But the individual investor has had a harder time accessing that. So that's not a bad thing. That's probably a good trend to democratize or increase access to this investment. I think the question of what's the right product design for that particular customer base, what's the education process that's undertaken, what's the sales process that is undertaken, those are really, really important questions, and our industry should approach those with much caution, because it is a different investor base than what we and they are used to. We're not going headlong into that. We still regard our institutional capital providers and very ultra high net worth investors as really our core base. And we think that some of the newer products and technologies with semi-liquid funds and such could be good vehicles to reach that existing customer base. So the 401k owner and the $1 to $5 million asset player that some have sought, that's not a segment that we're looking at because it doesn't really fit our model. But with the appropriate testing and the appropriate education process and clarity around rules and regulations, I think this ultimately will be a very viable investment avenue for all types of investors down the road.
And some people say, well, they're tapped out in terms of distributing to institutions because they've hit their allocations. Universities are souring on private markets, and so, well, this is the next place to go. Any truth to that?
It's a place to go. It's not necessarily the next place. The sovereign wealth funds and pension funds continue to have pretty significant, penetration upside for our asset class. So there is growth in that sector. To say nothing of, again, the ultra high net worth segment is growing very rapidly, and that segment kind of acts like institutions. So I do believe there's continued growth outside of that channel, but it is a big channel that over time will develop. And so I think it really gets down to what your goals are. For us, it's really been about alignment with the investor base to our strategy, ensuring that we have the right level of capital to support our growth and the diversity of capital. And once we've achieved that, we need no more capital than what will meet those goals. I do think that others have sought a model of saying, if there's capital out there, I'm going to go raise that capital, and then I'll think about how and where it's deployed. That's a fundamentally different business model that we're not participating in. But one that I think has actually generated a lot of headway into the retail sector for sure.
Speaking of capital, didn't you recently raise fund number 14? It was $14 billion. Coincidence
for
or
North
not?
America,
right? Is that a coincidence? I was like 14 and 14.
No, and 13 wasn't 13 either. So yeah, it's no. This is really about if we step back, for us, it's never really been about maximizing the capital base. And that's the funny thing and some surprising thing to some folks, which is, we used to grow our capital base because we had good returns and people wanted to then take those now larger dollars and reinvest it into us. And we've always defined first, what's the business plan that we have? How much can we deploy at a portfolio construction that really makes sense? And then what's the last question is really, what's the capital to meet that? And so we come up with our targets based on a pretty detailed business planning process that ultimately arrives at that number, rather than saying, how much money can we go raise? We've turned down a lot of capital cumulatively in our years because it hasn't met our business plan.
Historically, you guys have been somewhat famous for consumer brands, investing in it. You got Dunkin' brands, which I guess hometown favorite there for you guys.
Yes.
Canada Goose, Staples, Burlington Stores, Toys R Us. Is consumer still a focus for you all?
Consumer is, although consumer has changed a lot. In those names, you mentioned a number of retail names, and that was probably earlier in maybe 10, 15 years ago. And there's been tremendous dislocation in a number of those sectors, and so those have become, not when we invested in them, luckily, but in more recent years, with the incredible strength of e-commerce and Amazon and other models, that's become a tougher area of investment. But we're still believers in strong brands. I mean, there's a lot of discussion about the reduction in the importance and longevity of brands, but we found that brands are also not monolithic things. They can be evolved and adapted, and they can be segmented and stratified over time. And we have a playbook around doing that very thing and extending products and extending geographies. And so if you take Canada Goose as an example, as a great example of kind of a single geography, single product that we took into a real, multifaceted businesses with its own retail channel and tremendous amount of growth. So I think for the right opportunity, consumer brands, can still be interesting. And some areas of retail, we own Fogo de Chao and some other restaurant chains that we're also very, very bullish about.
I read somewhere that you're not so keen on U.S. data centers, which is a very hot area right now. And it also appears on the other side of the coin, though, that you are interested in financial services.
I knew my comment on U.S. data centers was potentially going to be taken a little bit broadly. I don't want to say out of context, because there's an important kernel of truth there, which is the large scale standing up of really big hyperscaler data centers as an equity development proposition is not our cup of tea. I think we believe it's pretty difficult to really foresee the right supply-demand balance in that area. Having said that, we're providers of credit, we're providers of technology. We have a venture capital company called Crusoe, which is instrumental to building many of these very large hyperscaler companies, cybersecurity and the like. So that's an interesting target segment. But where we're developers of big data centers is mostly outside the United States. We have one of the biggest data center platforms in Asia, and we're building a big one in Europe. And so I would say we like that category in general, but we're a little bit nuanced in terms of what part of the value chain that you're playing in there.
And financial services.
Financial services is broadly a sector that we think is interesting. I think when you take core balance sheet oriented financial services, that's more of a non-US phenomenon. And so that's things like in Asia. That's an interesting market opportunity. But we're big investments in fintech, in financial payments, in wealth management. We have a dedicated crypto fund. And so the newer technology aspects of financial services, ways to develop new and more efficient backends for banks, new products and services for consumers, those are pretty interesting.
You spent time earlier in your career in Japan, and I'm wondering how that informs your thinking, what you think about the Japanese market. Are you still interested in it?
Yes, I'll start with the last question. We're still very interested in. In fact, for someone who's been involved in Japan for 30 some years, 20 of it and 25 of it in kind of private equity, I do think we're finally seeing the attention that Japan deserved. I think when people were a little bit negative on Japan, I think they were too negative. They may be getting a little too positive because things in Japan change, but at a slow pace. But I think what you see happening in Japan is a genuine change in the nature of their economy. I think there's a big focus on corporate governance, on taking these great companies that had really interesting technologies, but maybe were not run as efficiently as their peers, and making them much more efficient. And then using those gains to now invest in new areas. So there's a very positive cycle happening in Japan right now. There's much greater receptivity to folks like us, and to thinking about capital partners and operational partners as people who can help them achieve their goals. Maybe not forever. It used to be like, oh my gosh, selling my company, we can't do that. We founded this company. It's been our family for so many years, or it's been part of this corporation as a business unit. That mentality has changed. And that's been, I think, a huge catalyst to private equity activity, and we're really bullish on it, building a lot in Japan right now.
And final question, you just became the sole leader of the firm earlier this year. So I'm wondering where you're looking to take Bain over the next, say, 5 years.
Sure. Well, probably a few dimensions I'll focus on. I think first is to really, protect and grow this great differentiated business model that I talked about. I mean, we're big believers in this value-added approach, in this differentiated vertical capability, and we've broadened our business and we've deepened it, as I mentioned. And now it's really about having the agility to bring together all these disparate pieces, because the most interesting opportunities that we find sit at the intersection of certain trends. It's healthcare technology, it's real estate and labs, it's defense technology, and it's not just one thing. And deals also don't move in a linear progression. Sometimes they start as a control deal and then they might turn into a minority deal. And so our ability to bring our different divisions and business geographies together to seek those opportunities is potentially a huge area of differentiation. So, I believe, one of my core goals is to really get us humming across this platform that we have, and to be agile to respond to market opportunities as they develop. That's number one. Second is absolutely to pursue this massive opportunity around technology and AI. This is a generational opportunity. As I said, it's like a kid in a candy store for us, because we're big on value creation and driving enterprise-wide change in companies. This is now a massively powerful tool to do just that. And so if we can be the ones who are at the forefront of applying and molding this technology so that it can help business processes achieve their business goals, that's going to be huge to increasing opportunity companies. It'll be an underwriting advantage when we look at a new investment, because we'll say, hey, we know how to leverage this technology to advance something. It'll help us stay away from areas that will be dislocated, and it will actually help us run our own business, because we're very knowledge and data intensive investors. And so think about all the years of history that we have across thousands of investments we've made. If we can bring that to bear with an intelligence tool that helps us make better investments, helps us forecast better, think about pitfalls and opportunities better, that's got huge potential. On the flip side, we have to be new economy company. We have to future-proof our organization. I think if you're not a leader in this area, you won't be the place. You won't be the talent magnet. You won't be the place that people want to come work. And so the third point I'd say is that we ensure that Bain Capital can attract the best talent, the best technology talent, the best people who are proficient with technology, the best people who understand life sciences and aerospace and defense. Look at this as a growthful, exciting place to come. And so that's my key goal.
David Gross, Managing Partner of Bain Capital, thank you so much for joining us.
Thank you. Really enjoyed it.
This is At Barron's. I'm Andy Sertwer. We'll catch you next time.